Most people believe countries collapse because of bad leadership. Corruption, ideology, populism, socialism versus capitalism. Those explanations feel intuitive. They give the story a villain. They make collapse feel avoidable. But they miss the deeper mechanism, because countries don't collapse the way companies do. They collapse the way balance sheets do. Slowly, structurally, and often long before the symptoms become visible. Venezuela is usually presented as a political failure. In reality, it is a financial case study, not of what happens when a country runs out of oil, but of what happens when a country loses access to global finance. To understand how it happened, we need to start earlier, long before hyperinflation, long before sanctions, long before the headlines. Venezuela's story begins with oil. In the early 20th century, Venezuela discovered some of the largest petroleum reserves in the world. By the 1920s and 1930s, oil transformed the country from a largely agricultural economy into one of Latin America's wealthiest states. For decades, Venezuela benefited from a simple equation. Oil exports brought in foreign currency. Foreign currency funded imports. The state redistributed oil revenue internally. This model worked for a time. By the mid-20th century, Venezuela had rising living standards, strong urbanization, expanding middle class, and a stable currency. Oil created prosperity without requiring industrial diversification. And that was the first vulnerability, because oil wealth masked structural fragility. The economy became import-dependent, revenue concentrated, externally financed. When oil prices were high, the system felt stable. When prices fell, cracks appeared. But as long as Venezuela had access to global finance, those cracks were manageable. Debt could be refinanced, currency credibility could be defended, imports could continue. Liquidity solved problems that productivity did not. In 1976, Venezuela nationalized its oil industry, creating PDVSA, Venezuela's state-owned oil and natural gas company. On paper, this increased sovereignty. In practice, it concentrated risk. Oil revenues now flowed directly through the state. The government became the central allocator of capital. Fiscal policy, social policy, and currency stability became dependent on one sector. For years, this still worked. Why? Because Venezuela remained integrated into the global financial system. It could borrow internationally, like its currency was trusted, its debt was serviceable, its oil exports were settled in dollars. As long as that access remained intact, inefficiency did not cause collapse. This is a crucial point. Economic mismanagement does not automatically produce disaster. Isolation does. By the 1980s, oil prices fell. Debt increased. External pressures mounted. Venezuela faced the same challenge many resource exporters face. Falling export revenues, rising social expectations, fixed import dependence. The solution was borrowing. External debt expanded to smooth consumption. The believer was managed through controls. Short-term stability was preserved at the cost of long-term fragility. But the country remained solvent because refinancing remained possible. Access mattered more than balance. In 1998, Hugo Chavez was elected. This is often treated as the moment everything changed. It wasn't. The system's weaknesses already existed. What changed was the use of oil revenue. Chavez redirected oil income towards social programs, subsidies, and redistribution. Spending increased. Private investment declined. Capital controls expanded. But here is the part most narratives skip. For most of the 2000s, Venezuela did not collapse. Because oil prices surged. From 2003 to 2008, oil prices rose dramatically. Revenue flooded in. Foreign reserves increased. Debt remained manageable. The system looked vindicated. This reinforced a dangerous belief that oil alone was enough. Diversification stalled. Institutional buffers weakened. Dependence deepened. The economy became more centralized, and the state became more dominant. Private capital retreated, but collapse still did not occur. Because access to global finance still existed, financial isolation does not arrive all at once. There is no single moment when a country is cut off. No switch that flips. No announcement that collapse has begun. It unfolds as a process. First, risk premiums rise. Investors demand higher yields to hold sovereign debt. Credit ratings are downgraded. Refinancing becomes more expensive, but still possible. At this stage, the economy is stressed, not broken. Then rollover risk appears. Existing debt matures. New debt must be issued to replace it, but fewer buyers remain. Short-term funding replaces long-term capital. Interest costs rise and maturity profiles shorten. The system becomes fragile. This is the phase where policymakers often believe they still have control. Spreads widen, but markets remain open. Imports continue. Payments clear. The illusion of normalcy persists. Then comes the critical break. Settlement friction. Correspondent banks reduce exposure. Compliance costs rise. Transactions slow. Payments that once cleared in days now take weeks or fail entirely. This is not a trade embargo. Goods may still be sold, but money stops moving efficiently. Oil can be shipped, but payment routes narrow. Insurance premiums rise. Middlemen demand discounts. Revenue still exists, but it no longer arrives on time, in full, or predictably. At this stage, reserves become defensive tools. Central banks stop supporting growth. They focus on triage. Imports are prioritized. Capital controls tighten. Access becomes selective. This is when parallel systems emerge. Black markets are not criminal innovations. They are liquidity responses. When official channels fail, informal ones replace them. Foreign currency circulates outside the banking system. Pricing becomes fragmented. Trust migrates away from institutions. The formal economy contracts. The informal economy expands. Not because people reject the state, but because settlement certainty matters more than legality. This process accelerates feedback loops. As confidence declines, capital flees faster. Currency demand spikes. Inflation expectations de-anchor as inflation rises. Domestic savings are destroyed. Credit collapses. Long-term planning disappears. At this point, stabilization becomes mathematically difficult. Even competent policy cannot restore credibility quickly, because credibility is cumulative and loss is nonlinear. Once counterparties expect delays, defaults, or intervention, they act preemptively. Trade partners demand prepayment. Lenders demand collateral. Investors demand exit. Liquidity drains faster than policy can respond. This is why financial isolation feels sudden from the outside. From the inside, it feels like suffocation, not collapse, compression. Every transaction requires more effort. Every import costs more. Every decision becomes shorter term. The economy stops compounding. It starts surviving. And once survival becomes the dominant objective, growth ceases to exist as a concept. This is the moment when inflation is no longer the problem. It is the outcome. Venezuela exports oil. Oil is priced in dollars. Imports require dollars. Debt is serviced in dollars. This creates a structural dependency. The country does not control its settlement currency. As long as oil exports reliably convert into dollars through global banks, the system functions. When that conversion breaks, everything else follows. This is where the real vulnerability was hiding. Not in ideology, not in policy rhetoric, but in financial plumbing. The real break came after 2013. Oil prices collapsed again. But this time, conditions were different. Reserves were thinner. Debt levels were higher. Production capacity had deteriorated. Institutional trust had eroded. At the same time, Venezuela's relationship with global financial markets worsened. U.S. and international sanctions escalated. Correspondent banking relationships were restricted. Access to dollar clearing became uncertain. This is the part that is often misunderstood. Sanctions did not reduce oil reserves. They reduced financial access. Venezuela could still produce oil, but monetizing that oil became harder. Payments became delayed. Settlement channels narrowed. Refinancing options vanished. The country was not cut off from trade. It was cut off from liquidity. And in a modern economy, liquidity is survival. When a country loses access to external financing, three things happen simultaneously. 1. Currency credibility collapses. Without dollar inflows, the central bank cannot defend the exchange rate. Capital flees. Parallel markets emerge. Confidence evaporates. This is not psychology, it is arithmetic. 2. Inflation becomes structural. Imports must still be paid for, but foreign currency is scarce. The state prints money to cover domestic obligations. Money supply expands without external backing. Inflation accelerates, then compounds, then becomes self-sustaining. At this stage, inflation is no longer a policy choice, it is a constraint. 3. The economy fragments. Price controls fail, black markets emerge, informal dollarization spreads, economic activity does not stop. It decentralizes. The formal system collapses first. Venezuela's hyperinflation is often portrayed as reckless money printing. That explanation is incomplete. Money printing was the response, not the cause. The cause was loss of external liquidity, loss of settlement access, loss of refinancing ability. Once those disappear, monetary discipline becomes impossible. The state must choose between paying obligations in devalued currency or defaulting immediately. Most choose inflation. This is where intuition fails. People ask, how can an oil-rich country collapse? Because oil without finance is stranded value. Oil must be extracted, transported, insured, settled, reinvested. Each step requires financial integration. When settlement channels narrow, oil revenue becomes illiquid. Production declines, maintenance stops, output falls further. The asset still exists, but it cannot function. The role of the United States is often framed in moral terms. In reality, it was structural. The U.S. controls dollar settlement, correspondent banking access, sanctions enforcement. This gives it disproportionate influence over global finance, not because of intent, but because of position. Modern power is exercised through clearing systems, credit access, liquidity channels. When Venezuela lost reliable access to these systems, collapse became mechanical. Once financial credibility is lost, recovery becomes nonlinear. To recover, Venezuela would need stable settlement access, currency credibility, external refinancing, institutional trust. But trust requires stability, and stability requires trust. This is the trap. Even if oil prices rise, proceeds cannot fully translate into recovery without financial reintegration. The economy remains partially disconnected. Natural resources do not guarantee stability. Production does not guarantee power. Sovereignty does not guarantee resilience. What matters is liquidity, credibility, access. Countries collapse not when they run out of assets, but when they lose access to the system that makes assets usable. Venezuela didn't fail because it chose the wrong ideology. It failed because it became financially isolated in a system that punishes isolation. If you want to understand how the global financial system actually works, not the simplified version, but the structure beneath it, this channel breaks it down in a clear and simple way. Subscribe if you want to recognize the shifts most people only understand after the consequences are already unavoidable.